Let's bring in Wharton School of Finance Professor Jeremy Siegel. Professor Siegel, great to see you as always. Thanks for joining us.
Happy to be here, Will.
So are you very bullish on the fact that we're adding further fiscal stimulus to the already significant monetary stimulus, or was that already somewhat expected and priced into the market?
Well, I think it was expected. And by the way, I think this is part one. I think there will be a part two later on in a reconciliation bill. And that one will have some tax increases in it, but some more spending. And the trend of the market is still decidedly upward. If you remember last week, just before the Fed meeting, I said we would have what I call taper tremors in the market, and we did, and we're going to have some more of those. I am not as sanguine as Jay Powell that this is just a fleeting inflationary expectation. But at the same time, that's not bad for stocks. Stocks are real assets. It's bad for bonds, but spending and moderate inflation is not bad for stocks.
So how big a tremor will we have, Professor Siegel, when Jay Powell, if that's what you're suggesting, comes out and confirms that tapering will start sooner rather than later, perhaps even at Jackson Hole in August? Yeah,
and perhaps even sooner than Jackson Hole. We have the next pricing data that I'm looking at is going to be that CPI on July 13th, and that's going to be very important in terms of and that's the bottom line that often shapes expectations going forward. So if we get a hot reading on that, and then the following day we have the PPI, he may be forced into a taper announcement even earlier than the August Jackson Hole conference. Again, I don't think that's it'll cause a tremor in the market because everyone thinks the only reason for the bull market is the easy Fed. I think there's a lot of other reasons why the market's going up. But nonetheless, these tremors are not over by any means.
Well, not just the Fed, Jeremy, Professor Siegel, I should say. If the Fed starts pulling back on the stimulus at the same time where fiscal stimulus is fading, it was pretty front-loaded. Do you not think that the economy faces a slowdown after these very high growth rates?
Remember, pulling back on stimulus means tapering $120 billion a month, keeping interest rates at zero. It's still extraordinarily stimulating in a strong economy and in a moderate inflationary economy. Any interest rate under 2% is still extraordinarily stimulating. So certainly relative to what we've seen in the last 5 years, it'll look like, oh my goodness, the Fed is beginning to tighten. But relative to the history of monetary policy, this is still a very, very easy and loose Fed, and I think the money will continue to flow into the stock market.
So equity is obviously a good inflation hedge in your mind. What are the other key assets that would be big weights in your portfolio at the moment?
Well, I think, and we've already seen them. Look at the property prices as we see. The median home price up 20%. Now, I actually said that when this inflationary bump that we're going to get is over, we're going to have a CPI that's 20% higher than we did coming in to the pandemic. So in one way, the property market has virtually jumped there already. In fact, many of the commodities have jumped there already. We're 20% on the CRB index above the pre-pandemic high. So, a lot of people say, oh, look at lumber's coming down, copper's coming down, everything like that. But they're still much higher than they were pre-pandemic. And I think what these more GDP-oriented indexes are very slow to catch the housing increases and the other inflationary increases that I think is going to last several years into the market. And people are going to just say, listen, I can't go into bonds. I'm going to go into real assets. Property's up 20%. That's pretty high. I still like stocks. And dividend yields that are protected from inflation look awfully good compared to a 1.5% long bond not protected from inflation.
Shepard Smith here. Thanks for watching CNBC on YouTube.